Welcome to this explainer. Today, we're cracking open McCormick's Q2 2026 earnings, and honestly, we're going to be digging deep into a really fascinating contrast. We're looking at their traditional, everyday consumer pantry spices versus their rapidly expanding, absolutely massive business-to-business flavor strategies. It's just a brilliant look at how a legacy brand navigates shifting consumer habits while quietly building an absolute powerhouse behind the scenes. So, let's jump right in.
But before we get totally into the weeds of this quarter, let's just anchor ourselves with the sheer scale of this company. McCormick boasts a market capitalization of over $14 billion. I mean, think about that. This isn't just the black pepper sitting on your kitchen table, right? This is a massive global enterprise with an enterprise value pushing almost $19 billion. Understanding that kind of scale is absolutely crucial for everything we're about to unpack today.
So, here is our roadmap for today. We'll start with a Q2 financial snapshot, look at consumer versus flavor solutions, then unpack margins and tariffs. After that, we'll dive into dividends and valuation, break down the massive Unilever Foods combination, and finally wrap up by looking ahead to 2026.
All right, Section 1, Q2 financial snapshot. A really strong start. Right off the bat, net sales surged an impressive 16.7% to land at $1.936 billion compared to the same period last year. You know, in a highly dynamic macroeconomic environment where a lot of consumer goods companies are frankly struggling just to stay flat, a nearly 17% jump in top-line revenue, that clearly proves the overall resilience of this business.
And that top-line resilience trickles right down to the underlying metrics. Check this out. Gross profit is up 25% to over $778 million. Gross margin expanded by a massive 270 basis points to hit 40.2%. Operating income jumped over 30%. And when we look at the bottom line, adjusted earnings per share jumped nearly 16% to 80 cents. So, from a high-level view, this was just a wildly successful quarter.
Moving on to Section 2, Consumer versus Flavor Solutions, a tale of two segments. This is where it gets super interesting, because there is a stark contrast between McCormick's two main segments. Over on the consumer side, organic sales were up a modest 1%, but actually that was entirely driven by pricing. The actual volume declined 2% as everyday consumer pantry habits kind of softened. But then, look at the Flavor Solutions segment. This is the B2B side powering massive food brands and restaurants. Organic sales there were up 3%, and that was driven equally by higher prices and higher volume. So the commercial segment essentially stepped up to carry the organic growth for the whole company. CEO Brendan Foley actually pointed out this exact dynamic in his remarks. He noted that total organic growth relied heavily on that accelerated momentum in flavor solutions. And this perfectly highlights the core benefit of their diverse portfolio, right? When everyday consumers pull back slightly on buying spices at the local grocery store, McCormick's commercial gains with quick service restaurants and consumer packaged goods step right in to offset those shifts. Let's move to Section 3, Margins and Tariffs, unpacking that 270 basis point jump. So we saw earlier that gross margins expanded by a whopping 270 basis points, but it wasn't just simple price hikes driving that profitability. It was a really strategic mix of factors. First, they saw accretion from their recent acquisition of a controlling interest in McCormick de Mexico. Second, they realized some solid savings from their comprehensive continuous improvement program. But third, and I think this is the most fascinating part, is the impact of a very unique legal twist regarding tariffs. Specifically, McCormick recovered $28 million from nullified country-specific duties. Because they source literally thousands of ingredients globally, they had previously absorbed heavy IIPA tariff costs. But after the Supreme Court invalidated certain tariffs based on emergency powers, McCormick essentially got a massive rebate. This $28 million refund acted as a huge tailwind, accounting for 140 basis points. That is over half of their total margin expansion for the entire quarter. On to Section 4. Dividends and valuation, rewarding the shareholder.
39. That is the number of consecutive years McCormick has grown its dividend. In the world of investing, finding that kind of historic reliability is incredibly rare. It really serves as a massive testament to the fundamental durability of their business model through literally decades of varying economic cycles.
Putting on our analyst hats here for a second, let's look at the value proposition. They offer a very healthy 3.68% dividend yield, paying out $1.92 annually per share with a totally sustainable payout ratio of just over 31%. But the really crucial point for value investors is that trailing PE ratio.
sitting at just 8.62, combined with a PEG ratio of 2.66, which, if you follow Peter Lynch's methodology, is a classic metric for balancing price against growth. The numbers suggest a deeply entrenched value proposition for a company that is actively growing both its top and bottom lines.
All right, Section 5. The Unilever Foods Combination. Scaling the future. Announced back in March of this year, this combination creates an absolute behemoth in the consumer packaged goods space. We are talking about a global, flavor-focused company generating approximately $20 billion in fiscal year 2025 revenue, all while commanding an industry-leading 21% operating margin. It is, without a doubt, a transformational move for the entire industry.
And McCormick is methodically executing this massive international corporate marriage throughout 2026. Following that March announcement, we're expecting news by the end of July regarding a secondary listing on a European exchange. Then, by September, they plan to pull back the curtain and share much deeper details on the operating model and exactly how they plan to achieve those growth synergies.
The financial motivation behind this deal is just staggering. They're projecting $600 million in annual run rate cost synergies alone. On top of that, they anticipate this combination will be accretive to earnings per share right out of the gate. They're expecting mid to high single-digit accretion in year 1, which then scales up to mid to high teens accretion by year 3. And that brings us to Section 6, looking ahead to 2026, the reaffirmed outlook. Management has officially reaffirmed their 2026 outlook, and they are confidently predicting strong double-digit growth. They expect net sales to grow between 13% and 17%, and adjusted operating income to surge somewhere between 16% and 20%. Now, while organic sales growth is expected to remain a modest 1% to 3%, the overall explosive top and bottom line numbers are largely being fueled by the highly successful integration of that McCormick de Mexico acquisition.
Ultimately, their entire strategy relies on what management likes to call a virtuous cycle of growth. They aren't just sitting on these expanding margins from tariff refunds and cost synergies. No, they're taking those strong margins and reinvesting them directly back into the brands, the digital capabilities, and the core innovations that secure their market leadership.
Which really leaves us with this final thought to consider. As everyday consumer pantry habits inevitably fluctuate, is McCormick's strategy of aggressively leveraging their massive B2B flavor footprint, especially with this upcoming Unilever integration, the absolute masterstroke that will secure their global flavor supremacy for decades to come? It's a really compelling narrative of scale and diversification. Thank you so much for joining me for this explainer, and I hope these insights help you better understand the mechanics driving McCormick's future.